we're not doing that great with employment. So the green bars indicate obviously job gains, and the red bar indicate job losses. So on the left side, early in August and September, we see a mixed picture. Then in late September and October, the bar turns strongly positive. But beginning in late October and early November, the trend flips violently. We see large negative spike. The shift is so abrupt that it demands closer inspection. What the heck is going on? So let's start with the beginning. August weakness. In early August, the ADP data shows a string of modest declines. The bars dip slightly below the zero line, indicates mild job losses or stagnation. That's not unusual. August often sees volatility because of temporary manufacturing shutdown. But in late August, then we see a dramatic red bar around August 30th. A drop of 18,000 jobs. Now, these are real numbers. We can't just say that the surveys weren't done correctly. We fired a bunch of people. No, these are real numbers. This suggests a shock, possibly one-off shock, such as maybe some major layoffs and tech sector restructuring. Who knows? A surge in small business closure. But the point is, the number is red for employment. So if you're the Fed, you're looking at this, and don't forget, we're going to get a rate decision pretty soon in December. Want to raise rates? Time when analysts dismiss this as noise, it becomes part of a larger story. In September, we have some gradual stabilization. Still, we're losing 3 to 10,000. Not great. Not recession. It's not a recession, but still, it's not a good number. Remember, at some point, they used to make 200,000 jobs. So the October hiring boom. This is where the picture gets interesting. Beginning in September 27 and lasting through October 18th, it's all green. We witness a sudden, powerful surge in employment gains. Look at those numbers. Boom, 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 right? 5, 10, 15, and then 27,000 jobs. But then this is a seasonal hiring ramping up early. Retailer, logistic, hospitality company, right? We are reopening momentum. Industries that struggle with labor shortages may have finally caught up. Better than expected corporate earnings. We had some great earnings. Some normalization after weak late summer data. This is important for you to understand these numbers. The October boom gave economists confidence that the U.S. labor was still resilient. We're still great, still flexible. But then, and this is the circle, the red circle, the picture changes dramatically. The sudden collapse in early November. Now we turn to the right side of the chart, the portion circled in red. Take a look at that chart. And you could see what is going on here. Right? We're having issues with employment. And that is a problem. That is a problem, my friends. And the reason I'm saying that is, as you could see, we move straight into minus 12, minus 8, minus 15,000. And these are not small declines. They are recession-like prints, the kind we normally only see during tightening cycles. Major shocks, or when businesses are preparing for a downturn. So what did this happen? Well, explanation number one. Employers expect slower demand. The first and most likely explanation is that businesses, especially small and mid-sized companies, basically expect a slowdown. Higher borrowing costs, margin compression, weaker retail sales, consumer credit stress, the whole thing about the tariffs. So when employers see risk in the horizon, they don't wait, they start cutting costs. Is that what they did? Number two, maybe they will also reflect falling new orders. Industries like manufacturing, warehousing tend to react quickly. Again, because of the tariffs, they stop hiring, they reduce overtime, they begin trimming headcounts. I mean, they're preparing for the worst. Is that what's happening? The red bar in November line up with several reports showing softening industrial activity. The number three is one possibility is that the losses are concentrated in a particular sector, maybe tech, logistics, manufacturing, construction, retail. A wave of layoffs in one of these could produce a sharp red we see. Explanation number 4 is just statistical noise. Again, these are just surveys. They didn't go and survey all these companies physically. It's possible, not likely, but possible that this affects a temporary adjustment quickly. So markets react strongly to patterns like this because clusters of negative data rarely happens by accident. I mean, it's 3 red lines. I don't know. So what does this mean for the broader economy? Taken together, this chart shows a labor market that is transitioning. We're not adding jobs. We are not adding jobs. This is something that you need to realize. We are moving from a post-summer weakness to an October hiring boom to an early November contraction. This tells us the economy is not a straight line expansion. It is entering a stop-and-start pattern where monetary policy is restrictive, but business confidence is softening, and growth momentum is fragile. So historically, when ADP gives us multiple consecutive weeks of losses of this magnitude, it often signals an approaching slowdown, lower consumer spending, rising recession probabilities, and more cautious corporate earnings. Careful here, right? And this is where the third part of this discussion comes in, because we're going to see what is the Fed going to do. So in this chart shows a dramatic reversal in the labor market. October hiring boom was short-lived, and early November now shows multiple weeks of significant job losses. The shift is loud, early, should not be ignored. Okay? So be aware of that. Be very aware of that. Because now we're going to talk about the third part of our discussion, what's going to happen in December with the Fed. What are they going to do? So let me show you this. This is basically my third chart, and I want to explain what you are seeing. And that's important because now, obviously, whatever the Fed does is going to impact you directly in terms of borrowing costs, in terms of mortgages, in terms of a bunch of different things. So let's take a look. At the shifting market expectation for Federal Reserve rate cuts. What are we seeing? So this graph basically shows how dramatically and how quickly those expectations can move in response to Fed communication, economic data, and market stresses. What do you think people lose who make a lot of money in the stock market? You need to understand what's going on. So let's break down. The first one, there are 2 lines on this chart. So be very clear. The green line reflects market implied probabilities of a rate cut by December 2025. The green line. First it was nothing is going to happen. And then, as you could see, as we get closer, right, on the vertical axis, and the blue line, by the way, the blue line reflects implied odds of a rate cut by January 2026. So, the blue line is rate cut January 2026. The green line is rate cut by December 2025. What is going on? Well, take a look at it. Look at what's happening in December 2025. That thing is shooting up. How interesting. They must be looking at the other chart I'm looking at just before. They're saying, hey, we might have an issue with unemployment, right? Let's see. So basically what you have on the vertical axis, you have high numbers, great expectation of a rate cut. Lower numbers, reduce odds. You have a split market. On one part of the curve is screaming for cuts and the other one is collapsed. So let's begin first on the left one. So this marks, as you could see on the left side of the chart, the first circle where we see the red oval labeled Powell. This marked the moment Powell made remarks that market interpreted as dovish on inflation, concern about slowing labor market, and open to easing. So, hey, we have ourselves a rate cut in December. That was early on. But soon after his comments, the green line cut odds jumped, as you could see. Right? The green line surges upward as traders price an increasing probability that the Fed may cut rates earlier or more aggressively. And don't forget, when you look at that chart, right, this is from October 29th. So we are recent. We are monitoring this thing like really close. So in December, it looks like it, but the blue line fell at the same time. Look at that circle on the left. Why? Well, because the Fed cuts in December, the January meeting becomes less relevant. We're not going to cut again. Right? This pattern is called the probability migration, where expectations shift from one meeting to another. I mean, I know this is complicated, but this is how you make money. You need to understand, and this is what I'm here for. I want to explain to you what's going on, but I mean, this is not easy stuff. And you want to make money, you want to understand, you don't want to lose your job, you want to know what's happening in the economy. You need to understand what is happening, and the data is out there. They're not showing it to you, right? They're not telling you, well, you look at this and look at that, but the data is out there. If you join my channel, I'll explain to you, obviously. And if you use my Patreon channel, then I'll show you for very specific recommendation to take advantage of that. So this pattern is called probability migration. So Powell's comment effectively pulled forward the timeline for easing, meaning that I am not going to, you know what? We need to lower rates, not in January, but in December. So December 2025 expectation drift downward slowly as we went since October. The green line softened as the market, waits for confirmation from inflation data, employment report, Fed speeches, credit market condition, and January 26 remains relatively stable. As you see in the middle, right? So blue line doesn't move too much. This reflects a wait-and-see approach by markets. Now, you have to understand one thing. Who cares about the rates? And you need to realize that there's an inverse relationships between the stock market going up and rates going down. Right? If tomorrow rates shoot up to 20%, the stock market is going to collapse. Why? Well, because don't you want 20% risk-free? I mean, I'm exaggerating, obviously. But there's an inverse relationship between the stock market and the rates. So you've got to understand what's happening with the rates if you want to make any kind of money in the stock market. So January 2026 remains relatively stable. Okay? And then we're moving forward, slowly but surely. As you could see, in mid-November, repricing begins. Around November 10th to 11th, we see another downward drift in the green line. This coincides with stronger than expected inflation readings, resilient consumer spending, sticky wage growth in certain sectors. These reports suggest that inflation progress has stalled. It's not an inflation story anymore. It's an employment story, which the Fed could interpret as justifying for delayed cuts. As a result, in December, cuts odds fall, right? Meaning market price less likely could have a cut in 2025. So, the green is just slowly kind of dying away, and the January doesn't go anywhere. Market is in limbo, but that ends quickly. Explosion in cut expectation. As you could see towards the right of the chart, look what's happening to the green line. Now we reach a dramatic right-hand side of the chart, heightening green. Suddenly, cut expectations for December 2025 not only go up, but they explode higher, rising from around mid-40s to over 80%. So we're definitely getting a rate cut. This type of rapid repricing only occurs when markets interpret something as economics threatening, financial destabilizing, a major shift in the Fed willingness to intervene. So what's causing that? Well, first of all, look at what I just showed you before. Mass layoff of negative ADP report. Financial stress, maybe some corporate credit spreads are widening. Sharp tightening in financial conditions. Equity market drawdowns, dollar strength, who knows? Whatever triggered it, traders now believe the Fed must act in December. That is a problem. That's a problem because if the market, whoever that is, believe that you're going to have a rate cut, and as you could see, I'll show you how to make money. See that rate? That everyone expects a rate cut, right? Therefore, they expect the rate cut. If they don't get that rate cut, the market is going to take a hissy fit. Maybe if you feel that you know more than anyone else, then get prepared for it. Maybe you should hedge. Maybe you should buy protection. Maybe you should buy a put, because if they don't lower the rates, you hear. But even if they don't lower, even if they talk about not lowering the rates, the market is going to have a hissy fit again. Don't forget, we went down 2% not too long ago because they thought the market was overvalued. Then we lost another 2% because of what happened with the rare earth minerals, right? China didn't want to give to the U.S. and the U.S. say, "Whoa, you know what? Then what I'm going to do is I'm going to raise on it. I'm going to lower the tariff I'm going to raise tariff by 100%. So we lost another 2%. Imagine if the Fed says, "You know what? I'm sorry. I'm concerned about inflation again, and I don't want to do what the administration wants me to do. So therefore, I am going to not do anything." Well, first of all, I don't think that's going to happen because Powell is in duress, is under stress. A lot of these people want to become a Fed chairman, so therefore, I don't think that's going to happen. But that's how you make money. If there's even an inkling, if you think that somehow somebody's going to say something, and maybe somebody does say something, so therefore you put a very short-dated put on the market and you wait for it to happen. And if it happens, you trigger it, you make money, and you get out. Because at the end of the day, I think someone's going to say, no, this is not going to happen. We are going to lower. We're going to lower rates, as you could see. But lots of people talk, lots of volatility. You could make market. You could do a straddle. You could make market when the market goes up and the market goes down. A very short. Don't want to. You have to understand what options are, but it's always a possibility. So equity market drawdowns, dollar strength, and surging long-term yields can force the Fed's hand. Whenever triggered, traders now believe the Fed must act in December. Whenever you hear something like that, they must do something. They better do it. So this is comparable to the market behavior we saw in 2019 when the Fed was forced to cut rates in the face of slowing global momentum. Even a core inflation remains elevated. And of course, as you could see, the January 2026 expectation of a rate cut collapsed accordingly. Because the market assumed if the Fed cut the rates in December, then we won't cut again. Or in December, cut is one done and stabilizing move, and that's it, right? It means market expect a very specific kind of Fed pivot, a single strategic cut, aim at stabilizing conditions. So the split curve basically tells us that several critical things. The first thing is telling us that markets believe Powell is leaning dovish. I don't know if you remember, beginning of the year, he was the guy that said, look, I'm looking at 125,000 job creation with ADP. I'm not lowering the rates. No way. The economy is doing great. And remember, the president was after him, do this, do that, lower the rates. I'm not doing it. Of course, what we now know is that the Office of Business Statistics basically was making big mistakes, meaning that they didn't know what they were doing. Not they made mistakes, but the surveys were incorrect. And in fact, we didn't have 100,000 jobs. We had less than that, and some of them were actually negative. So, second, economic data has deteriorated enough to force the Fed's hand. That's what caused a massive surge in December cut odds. And third, traders expect the Fed to move cautiously. And this is not a recession probability chart, it's timing probability chart. I'm not saying this is a recession. We're just talking purely in terms of what the Fed is going to do. Now, of course, depending what the Fed does, if they do something or they don't do something, you could make money on the way there, right? deciding even on the volatility, and you could make money after that. Although at the end of the day, the market is going to go up. Why? Well, because when we say the Fed, we're not just talking about Powell. There's a bunch of people there, and most of the people there are now on the side of the administration. In fact, there's a guy there, a Whalen, that basically wants to become the Fed chair. So obviously he's not going to go against. There's another guy that was hired. In fact, he still worked for the government, believe it or not, and he's also on the Fed. And he said last time he wanted not 25, he wanted 50 basis points rate cut. So all these people, and then of course you had the people that were with the administration to begin with. So it's starting to weigh heavily in terms of lower rates. So you're going to get lower rates, even if you have some inflation numbers going up. Because at the end of the day, do we really have an inflation problem in this country? I mean, I'll do a video on that. But when you look, we were supposed to have inflation because of what happened with the tariffs. What really happened with the tariffs? The U.S. targeted 15% the entire world, more or less, and nobody did anything except China. And then all these companies, basically got into the stock market, and nothing happened. Right? All these companies basically took it in the chin. They had 40, 50% tariffs on their end. Don't forget, it's the U.S. company that pays the tariffs, and they didn't pass it on to the consumer. The question is, what's going on with crypto? That's a separate discussion, but let me address that very quickly. You see what's happening, right? Obviously, crypto is taking a hit. Now, if you look at behind me, you could see some of the chart about the stock market, well, I mean, it's doing okay, right? As you could see, most of it's green. The issue is, how long is that going to go, right? Thing with crypto is it's a very crypto that you have to understand that crypto, there's nothing behind it. All there is a belief and a liquidity, meaning that you don't make crypto all over the place. It's a mathematical formula that allows you to milk and create it, and people are using it, and the current administration is all after crypto, so that helps a lot. But in terms of the U.S., well, I don't know. I mean, I'll be very cautious right now. Of course, coincidentally, interestingly, I would say, you notice that the crypto was doing great when they were concerned about inflation, right? And now somehow, because inflation is not an issue, it's more unemployment, now crypto is starting to weaken. Obviously, crypto and gold and all these things are tools to circumvent and mitigate inflation. Can't have inflation if people don't have jobs. If you don't have a job, you're not buying anything, so therefore you're not going to do it. So keep all these things in mind. They are going to become very important.